Niklas James, welcome to Acquiring Minds.
Thank you very much, Will.
Niklas, you've got a great story for a lot of reasons, but among them, how you've evolved from a searcher to an independent sponsor. Now, the independent sponsor model is not one I've really addressed directly on the pod. It does come up in passing from time to time. So you are the perfect person to explain to us searchers, us acquisition entrepreneurs, what exactly the independent sponsor model is all about, how it's different, who should consider it. And you're doing this in the HVAC, the HVAC industry, which we hear a lot about in our world of buying businesses. So we'll also have the opportunity to spend some time on getting the basics of the HVAC industry. But let's start, as we always do, Niklas, with some background on you, please.
Yeah, fantastic. Thank you again, Will, and it's exciting to be here today. The first thing you'll notice is that I have an accent. I'm from Norway originally, so I grew up in a small picturesque town called Stavanger, Norway. I went to college there and then did a master's degree in London. Started my career at Bain, where I was mostly in their private equity due diligence group. After Bain, I had a quick stint working in venture capital before I did my MBA at HBS. And then after my MBA, I moved to Texas, where I've been for 10 years now. Just got back from my HBS reunion here a couple of days ago. And in Texas, I first worked in the oil and gas industry for a few years. This was when fracking was booming and oil price was 110. And then as soon as I got my green card, I had been very inspired by a lot of my HBS friends who had done search funds and acquired businesses by then. So I left my job and, started a career as self-employed. And since then, I've been in this search fund / independent sponsor space now for 7 or 8 years. Been involved in a number of things and excited to be here to talk more about it.
Great. Now, let me ask something on the side here, Niklas. When I would imagine a reunion at HBS could be of all of the kind of high school or college reunions you could have, that would be an anxiety-inducing reunion. If you're not, the prime minister or president of a country yet, you feel like you're underachieving. What's the vibe like at an HBS reunion?
It's a great question. And this is actually a topic of conversation when you go to these reunions. There are certainly a lot of people who've done very impressive things by the time you get to the 10-year mark. But I also think by the time you get to the 10-year mark, everyone has experienced life in different ways. And that can be on the personal side or on the professional side, but everyone has had ups and downs. So, the story at HBS goes that, and in fact, one of my professors, the parting words from him was, do not go to your five-year reunion. Because at the 5-year reunion, everyone is just 5 years out. People haven't quite started to have families yet or had any health issues. Everyone is really into their careers and supercharged and doing well. So it's pretty intense. But by the time we get to 10 years, and apparently it gets even softer as we get older, it's more about, how many kids do you have, and where do you live these days, and, what are you experiencing, and less so about kind of who is earning the most money. I would say it was a really affable atmosphere all weekend long, and the school does a fantastic job of putting on a great show with good speakers. And I had a fantastic experience.
That's great. Well, it's nice to hear that even in the august world of HBS that everybody gets a little bit softer as with age. That's reassuring for me. Okay, well, you have touched search in a number of ways. I know your story, but let's give a little bit more to the audience. You initially set out to do a traditional search fund, actually. Tell us that story.
Sure. So I was still employed in the oil industry. And this was back in 2014, 2015. A few of my friends, as I said, from HBS had graduated and gone on to do search funds and acquire businesses. So they would give me tours of their facilities, which was very inspiring. And, look at them and say, what do they have that I can't do? And my answer was, I can probably have a crack at this as well. Out of HBS, there are two models that you can pursue. There are also kind of a professor-sponsored but similar to traditional search fund that you could go. But I hadn't been in that class, so that was not an avenue for me. And then it was the traditional search fund, and I started networking with people who had gone that route. I spent a couple of months traveling the country. I was still employed, I think, when I met a lot of the investors in the search fund space. So I raised a fund, 400,000, or maybe it was 450,000. And as you know, the fund is meant to give you a salary of, call it 90,000 a year, and then also a budget for 2 years. And in exchange, you lock in for 2 years, where they own your deal flow and they have first dibs at any deal you may pursue. So I raised the fund, and then I actually made the decision to not cash those checks. So I called back to all the investors and I said, love meeting you. Look forward to having you as a mentor. Would love to have you as a capital partner if and when I find a deal. But at this stage, I don't need to lock myself in for a $90,000 salary. And there are a number of reasons for that. But that was the calculus I made. And why? Well, first of all, my wife was working. I was also a couple of years out of HBS. So I wasn't desperate for $90,000. And I realized that I would give up some economics down the line, potentially, by going the traditional search fund model. Mm-hmm. It's a very specified, formula for what kind of economics you get, but they actually own your deal flow, and you're not really as independent as I maybe was hoping to be. Also, and this was important, I was talking to a company about a position that was quite interesting just at that decision point that they were maybe looking to hire me for. And that made me realize that it would be nice to be flexible. I've just quit my job by now. And who knows what's going to come up in the next 2 months or 2 years. But it's nice to be autonomous and be able to be flexible. So those were kind of the reasons behind why. And more than anything, I think I understood early on that the major bottleneck in private equity is not capital, it's deal flow. So I trusted that if I do find a good target and get it under LOI, then I will be able to find a capital for it. And I think I, along with many others, have found this to be true.
Mm-hmm. Well, that's something that my audience has heard a lot on here. If you have a deal, the capital is there for you. It's not as intimidating as raising capital can be to a first timer. This was what actually this past Monday's episode was all about with Kevin Biebelhausen. If you actually have a good deal, you put one foot in front of the other, you do some outreach, and it's actually not that difficult to connect with people who would be more than happy to help you with your deal. So that's a great point for you to emphasize. And just out of curiosity, Niklas, how did your traditional search fund investors react when you called them back and said, "Actually, I'm going to send you back your check, or I'm going to tear up the check"? What was the reaction there?
I think most of them didn't react. They are busy and didn't reply to that email. Most of those that did react, for the most part, reacted positively, and one reacted with some disappointment, but also reaffirmed that yes, if please let us know about your deal flow, and we'll take a look. Which kind of reaffirmed my belief that it's all about the deals that you bring to the table. So. Okay,
and so in this decision, Niklas, it sounds like there were. You weren't actually sure what you were going to do. You had this very nice W-2 offer, which you did. I don't think you ended up taking. You had the traditional search fund money. Then you were contemplating, I guess, going self-funded. So how did all of that shake out? Yeah. And where are you living at the moment?
Sure. So the self-funded model, or that terminology, hadn't yet been established. So this was 2015. So I'd never heard the term self-funded search. But that is what I ended up doing. I ended up pursuing a search. I was sponsoring the search itself myself, and then not taking a salary. And so I was living in Houston, Texas at the time. And I started, just like any other searchers, building the infrastructure and reaching out to intermediaries in particular. I would say my search also, one thing that distinguished me was that I had been in the oil and gas space. I had also spent quite a bit of time in oil and gas while I was at Bain. I'm from an oil and gas town in Norway. And my thesis going into this was actually a little bit more specialized. I saw that in 2014, there had been a huge crash in the oil market. Oil had gone from $105 down to $26. And it was because of the activity happening in Texas. So fracking had taken off. There was a lot more production happening in the US, and the US was on its way to becoming energy independent. And I saw that this activity in the US, it's going to sustain, and it's going to be at the expense of more expensive production areas around the world, such as Venezuela or Canada or Brazil. So my thesis was that this is a great time. The oil industry is down, but activity long-term in the US and in Texas will be strong. So that was kind of my thesis going into it. And so initially I spent probably half of my time focused on finding oil and gas deals. And I would love to talk more about, the benefits of specialization. But that was the initial thesis that I was trying to garner support for when I was raising money. And yeah, I do want to repeat that it was not deliberate that I didn't cash those checks. That it was my intention to raise a traditional search fund. But, as part of meeting 15, 20 investors, you're also learning about the model. And one question that I would ask each and every one of them was, you're in this space already. You're very experienced with this. You see deal flow every day. How can you help me generate deals? And the answer was always, well, that's your job. And that's why we're investing in a search fund, which is fair enough. But I also realized that's the bottleneck for all of us. So if they're not going to help me with anything but a modest sum of money, I would say, then let me have a crack at it on my own. And maybe I can negotiate something interesting down the line that is more bespoke, so to speak.
Mm-hmm. Mm-hmm. Okay. So you are spending half your time in your search looking at oil and gas around a particular thesis, given your experience in that industry. And I guess half the time kind of as a generalist, looking at anything and everything. Take us up to the deal that you found.
Yeah, sure. So in the initial time period there, I you look at everything that comes across your desk, right? So I found a couple of deals on oil and gas. I actually got them under LOI or close to LOI, but the industry was just really suffering, and it was really hard to actually find capital for those deals once I found them. So I ended up eventually moving away from oil and gas entirely, just because it took longer for the market to recover. And I believed in the deals, but the capital was just not there. People were scared. So I diversified as we got through 2016, and I was under LOI first with one software company in Florida. That didn't close. I walked away from it after a couple of months, and then I eventually got under LOI with another company late in 2016, which was in the edtech space. It was a SaaS business where the customers were school districts nationwide. And that deal ended up closing a few months later, and I took the reins as CEO. And it's really quite similar to what you hear today. Is the kind of prototype self-funded search model deal.
So, and just to spoiler for the audience, this is actually not the business that we're going to spend most of our conversation on today. This is actually another deal that you've closed and have experience in, but we should give this story a little bit of attention. So let's spend a few minutes on it as well, Niklas. So you said it's kind of prototypical. Can you fill that out at all?
Yeah,
can you give us some bullet points, numbers?
Yeah, so it's an edtech business, a SaaS business, recurring revenue from school districts and private schools. And the EBITDA was advertised as around 1.2 million. It had maybe a dozen employees. Most of them were engineers. And it had been around for, I think, 6 or 7 years. I can't quite remember. I closed the deal with the SBA loan and also with just investors from the search space. Coincidentally, none of the investors were the ones I had up front 18 months earlier, but they were in that search space, all of them. And most of them had specific knowledge with software deals.
And just curious why none of the investors from your traditional search fund raise came in, because traditional search fund investors love SaaS. Well, everybody loves SaaS, but particularly traditional search fund investors.
Yeah, I was going to say I can't remember, but actually I do remember. It was my terms. So of course by now I had a good deal, and I did an SBA loan, which enables you to raise less equity, right? And so I wanted a higher portion and majority control for myself, and that was something that the funds in the search space were less comfortable with. And the individuals and kind of like family office style investors were more flexible to take a look at. So that was the reason.
Okay. Well, Niklas, yeah, this sounds like, I mean, maybe to say it sounds like the dream is a little bit strong, but SaaS, I mean, they're hard to find a hotter industry except maybe HVAC, your other industry. SaaS, everyone wants a SaaS deal, one doing $1 million in EBITDA or a little bit over $1 million EBITDA, at least advertised as such. In ed tech, I don't actually know if that's considered a good or bad, but it's B2B. I mean, you're selling to private schools and in school systems. And you were able, I mean, it wasn't at such an egregious multiple that you were able to finance it with an SBA loan. So these are all, this sounds like a unicorn. I happen to know that it wasn't as good as it seems. So let's continue. What goes wrong?
I was very excited, and nothing beats the exhilaration of closing a deal and meeting the employees on day one. And yeah, it was fun. And just going through the process, it's tough when you're in a deal. By the time you get to closing, you're kind of so numb that you're almost at the verge of being indifferent on whether it happens or not, because it's just been so tough to deal with creditors and investors and seller and insurance and everything going on. But of course, once you get it across the finish line, it's a major milestone. In this particular case, however, I would say we learned pretty quickly that the business wasn't going to have the growth trajectory that we were hoping for. And the core reasons, I could write a book about this, but the revenue really wasn't as sticky as expected. And that was both because of company issues that you would always expect. There are always some skeletons in the closet, and also because of the contracts that were there. So, and then also we're hitting some issues, macro issues in the industry that were just starting to emerge. I was cognizant of them prior to the deal. They were part of, the pitch book to the investors. So it's not that we didn't know, but they became a lot more pressing, a lot sooner and more dramatically than we expected. So it was just, there were headwinds in the industry that just happened quite quickly after we closed. In fact, on the day I closed, Google announced that they were entering the space. And that's just not great when they come in with a free product. So that was one of the issues as well. So we experienced a significant customer churn right out of the gate, and cash flow got pretty tight very quickly. So yeah, it was a little bit of a troubled investment from the start. I think that's the kind of situation where you learn the most. And it became a learning experience from that point onward.
Immediately, I mean, day one news, Google's entering your space. Sounds pretty terrifying. And it continues to be challenging. Why don't you just kind of accelerate us through the whole experience? How does it end? How long do you spend on it?
Sure. I think, many people encounter bad deals. This is why private equity funds have portfolios, because they know that every now and then a deal isn't going to work out. I quickly understood that this is a recovery mission. And the one thing that I'm happy about looking back on it is that it happened quickly. At the time, of course, that feels terrible because you just closed, and within a month or two of closing, you're kind of spiraling downwards. But the benefit of that is that you're eventually able to move on faster. It's better that way than being stuck for 10 years, right? So anyway, it was a recovery mission, and that of course sucks, but we had a loan, and that then becomes the priority. And it sucks because your incentives start to misalign with the investors. They've invested equity. They want to see 3x return on that. The bank, they want obviously to get their money back. So, and then you also have to deal with fiduciary obligations to both creditors and shareholders. So it's really a tough balancing act there. And just to give you an example on how that kind of materializes, you go 6 or 12 months into this, the bank wants to play it safe, be lean, don't hire more salespeople, just continue to produce cash to service the debt. The investors who are seeing that there's not going to be a good return unless we do something dramatic, they will encourage you to take the route of doing a Hail Mary, invest a lot, see if it works out. And if it doesn't, then too bad, but at least we gave it a real shot. And for them, and a good investor will have a portfolio of deals. So of course they want to maximize what they can get out of any given deal, but the creditors are not a concern of theirs. So everyone is acting rationally, but in a troubled situation, that also means that the incentive starts to misalign. And that became a real challenge and something I learned a lot from dealing with.
Mm-hmm. Niklas, when I hear you talk about the investor motivations here, and they have a portfolio, so they just really want, there's less risk for them in doing a Hail Mary. There is so much risk for you as an SBA borrower in a personal guarantee. I can understand, in a VC, in a venture environment where the same thing, venture capitalists have portfolios and only, it's one unicorn that pays back the other 19 bad deals. And so kind of Silicon Valley style VC is all about Hail Marys. But in those cases, the entrepreneur can really resist that as well because they don't think it's the right thing. But the entrepreneur doesn't have a personal guarantee. So their downside is limited. Your downside, the SBA borrower's downside is no joke. And there are real ramifications to that. So can you respond to that at all?
Yeah, and I agree with you. I think the traditional search fund model has really moved more in that direction of VC. And let me explain what I mean by that. I think if you go back 15, 20 years, you hear about how they would support, construction companies or tow truck companies was a big success, obviously, right? And they were happy to invest in businesses where they could get the 3x return, and it was fun for them to access that. But then the tech boom happened, the whole decade of the 2010s, that's where the valuations were rising. And I think more and more the investors started viewing it as a portfolio, and they wanted to pursue 10x opportunity deals, realizing that not all of them will happen. And I think that a little bit conflicts with the interest of the search funder, because a search funder will have a good outcome and a good track record if they can close a deal that eventually does 3x. And that will set them up for the next stage of their career. But however, if they do a tech deal, for instance, that tend to be, have a broader range of outcomes, it's more risky for them. And when you're a searcher, you only do one deal. So and you're committing a lot of time to that deal, both before you close it and of course running it for 5 years. So I think that's also another reason why, by the way, I like to be self-funded, is that I wasn't going to be pushed so hard towards tech deals, even though I ended up doing one in this case. But yeah, more specifically to your question there, we did our due diligence on this deal. Remember, I spent the early part of my career doing due diligence for private equity, and looking back on it, I don't, regret the decisions that we made. We were working with the information we had at the time. I had really smart people advising me. I had really smart people putting their money into this, and it was actually an easy deal to raise money for. So that tells me the thesis was strong and credible. And it's just a matter of fact that you don't always know what the outcome is going to be down the line. And this is true for every fund out there. So I learned that the hard way. And it being the first deal out of the gate, that's obviously not what you dream for, but you certainly learn a lot. And I would say for subsequent deals, I hear from investors now that it's almost safer to invest in me now, because I know what it is to go through a troubled deal, as opposed to someone who is 28 years old, is a little oblivious of how tough it is to go through this. Even if they understand what it looks like on a spreadsheet, they don't know emotionally the drain it will have on you. And of course, when you've been through it, you have a much higher aversion to ever encountering that again. So that's kind of the story that I like to present now to investors. So I've had, by now, both sides of the coin experiences, and I think that really strengthens your perspectives. And
so you believe that of yourself as well, because I guess the conventional interpretation would be, somebody has a quote unquote failure. I use that, I put that term in quotes, but this didn't go the way you wanted. That would be bruising to your ego, to your confidence. I assume you probably had both. You probably, yes, it was bruising to your ego and confidence, but at the same time, it also, like you just said, it gave you some armor, it gave you some experience to kind of, on the other side of the ledger, grow your confidence and feel much more equipped to go out and do this again.
Yes. The key, as we said earlier here, is to be able to make it happen. I was able to source a deal, finance a deal, close the deal, and then I operated it. And even the operations phase, I'm proud of what we did as a team. I think we managed this company well. We implemented some new things that could have been good growth opportunities. I basically did the Hail Marys that was wanted from the investors on a shoestring budget. So I'm proud of what we did, and going back on it, you make decisions with the information you have and at the time you have to make them. And the outcome will fluctuate from situation to situation. But if you put yourself in situations where there can be upside or downside, then eventually you're going to get a situation that is good. Again, going back to why it's so important with portfolios and investing in general. As far as capital raising goes, yes, when your most recent deal as a sponsor or a search funder wasn't a great narrative, it makes it a little bit more of an uphill battle. But it's, I think, more emotional than anything. First of all, I believe that most investors invest first and foremost in the deal. Over time, maybe they will just trust you so much that they will invest in you as a person, and everything you vouch for, they'll go for. But they always look at the deal. So that's going to be, large percentage of their calculus on whether they want to do it or not. So if you have a deal, they will evaluate it on its own premises. But then as I got to future deals and I shared, my most recent deal, it went a little sideways. Here's what I learned from it. I think that, first of all, it made me very trustworthy because I disclosed it, and that instantly connected them to me. Secondly, it gives you credibility because you've been through it and you know what you're talking about. You know why this deal you're now working on will contrast that. And as I said, I think that builds a bond and also some trust that, if anything, I've had really good reception from investors when I disclose both the ups and downs that I've been through as a searcher.
I have a bunch of things here I want to get to. Before we get too far away from it in the conversation, I want to circle back to what you were just saying about how search fund investor motivations started being influenced by the returns being seen in tech, and how kind of their approach to each individual deal changed a little bit. I just want to use that opportunity to highlight how important it is that if you raise money from investors for your self-funded deal or otherwise, but particularly for self-funded, you really understand the motivations of your investors.
Right.
Because they have different motivations. They have different time horizons for their capital. Some will, kind of have a more kind of private equity model where they will want to see a liquidity event within X number of years. Others may kind of have a permanent equity model and be fine just, collecting dividends from you and the business you buy indefinitely. So, and that's a very, very different approach by investors. And so you need to figure out what you want, and then you need to make sure you understand what the investors want and that they align. Kostub Dio talked about this on the panel at SM Bash. And yeah, I mean, he laid this out. He wrote this down for himself. He had it very clear in his mind, so he could communicate that transparently and clearly to the investors, and only select and only work with investors who were similarly aligned. So that's very important. Okay. The other thing, just before we move off of this story, Niklas, that I wanted you to just speak to is SaaS. So you bought in the hottest of hot industries. Everyone loves SaaS for the reasons that we know. There's no marginal cost to a sale, recurring revenue, everything. Software is eating the world, et cetera, et cetera. And yet it was a very challenged experience for you. What did you learn about the truth about SaaS, maybe that isn't obvious to the rest of us who think it's just the best possible type of business you can buy?
There are a lot of people who know a lot more about software than me. So this is just my opinion, of course. But I think SaaS, first of all, I think the valuations these days are very, very high and can only be justified if you accomplish very strong growth. That growth is not guaranteed in any deal. And in my experience, I learned that stickiness or recurring revenue is not as sticky as you maybe expect or calculate or anticipate. So I learned that the hard way. And why is that? Well, it's because technology changes much faster than any other industry, right? I mean, that's the whole premise of technology. And I think you never quite know where the industry is going to be in 10 years from today. Google just had a red alert earlier this year because of ChatGPT. It can really compromise their search business. Meta or Facebook, they lost 80% of their market cap in 2022. They've recovered some since. But this just shows you that even the biggest and most powerful companies are vulnerable to technology development that happen outside of their control. And so when you're a small SaaS player, you're always at the mercy of some competitor coming in And of course, if you're really successful, you're going to attract competition as well. I understand software can be very successful and it is sticky for many, but not always. And I think that's something to understand. And if it's 98%, recurring revenue today and sticky today, that doesn't mean it'll be 98% in 3 years from today. So I think because there's a lot of upside, there's a risk reward profile out there, right? And yes, there's a lot of upside with software companies. They're easy to scale because they don't have bottlenecks like many other industries do. But for me, that also means the risk is higher overall. And if you're, again, a portfolio investor like a search fund or search fund investor, I should say, right? You do 20 of these deals, it's going to work out in your favor. But if you're a searcher and you only do one deal, I'm not saying I'm never going to do a software deal again, but there is something very comforting about, in my case now, I'm working in the home services industry. I know for sure people will need plumbing in 10 years from today. So I know demand will be there. I don't know exactly what it will be, but it will be within a small band. And I don't actually know for sure that Facebook's advertising revenue will be there in 10 years from today, right? And so you can then downplay that to any other software company. So that's just a perspective that I've developed over time.
That's well put. Thank you. You had said that this hard experience with the SaaS acquisition, you did emerge from it wiser, smarter, stronger, and frankly proud of what you'd accomplished. But let me ask, you talked much earlier about how you had friends from HBS who did search funds, and you fell in love with the model, the idea of buying your own business. Then going through it and having your first experience be quite difficult, were you at all disillusioned with the whole concept, the whole idea that you would buy a business and put all your eggs in one basket? Or were you like, I did the best I could, but I still love this concept. I still want to go out and do it again? Because you did. Go on.
Yeah, I did. I think it's a little bit yes and no on that, I would say. I didn't lose my kind of confidence in the model and private equity overall and the upside potential that you can have in it. But I had become more familiar with the risks, and by now I had children. So, I had to ask myself, am I ready to take on similar risks in the future? Or do I want a more stable life, right? I mean, when you're in a troubled business situation, it consumes you night and day. In my case, would wake up really early in the morning just because I was so stressed. This never happens in my life, but it did happen in this period of my life. So, it becomes a personal question whether or not it's still a fit for me. But overall, for the model, I would say I still very much believed in it. Nothing had dissuaded that. I knew that it was situational, not structural. So I guess I was happy that I gave it another try. But and I guess this will probably be your follow-up questions. I'll just go straight into it. It wasn't only by choice that I continued to do the same thing, right? What I also learned as I started talking to executives, recruiters, started applying for jobs, perhaps in this little interim phase where I had transitioned out of the SaaS business, and I hadn't really made up my mind yet about whether I was going to start a fully fledged search for a new business to buy. I think I just learned that they couldn't appreciate what I'd been through. I had sourced companies and talked to business owners nationwide in every imaginable industry, learned so many things. I'd negotiated with them. I had financed the deal. I'd closed the deal. I then worked with creditors and attorneys and investors, and you manage the workforce, you develop new products. You do so much, and it's on a day-to-day basis so exciting, everything you get to be involved in. But a recruiter couldn't really appreciate that. And my experience was that if I just stayed those extra 2 or 3 years in consulting, that would have actually been more valuable from the recruiter's perspective because my resume would be more clean. They didn't even know it was a bad deal or good deal. I didn't even go there. I was just saying, this is what I've spent my career on doing. And so I found that my career would really, if I went that route of going for a W-2 job again, it was really like going 2 or 3 years back in time as far as which positions I could access. So that was only modestly exciting and a little haphazardly. When you're a searcher, you continue to get emails about deal flow, and so I at least looked at whatever came through and just kind of got going again with that. It wasn't necessarily as deliberate as it just happened that way, and nothing else more attractive had come up. So I started engaging in deals, and then it kind of snowballed from there.
Mm-hmm. Great. Well, let's get into the snowball. First, what year are we in at this point?
Late 2018.
Late 2018. You're flirting with interviewing, looking at W-2s, but you still got deal flow coming in, and those are enticing. So what happens between that period and finding your first acquisition?
Yeah, sure. So I connected. My wife started working. She had also been in consulting forever, and she started working at Lennox International, which is a large manufacturing company that manufactures HVAC equipment. She was quite senior, reporting directly to the CEO. And that gave me a front row seat to an industry that I hadn't considered specifically before, but that looked compelling. And, within a few weeks of her taking that job, I connected through a broker with a business owner in the Dallas area. And we just really hit it off. He was 5 years older than me. I thought he had kind of a good platform that with my help could be taken to the next level. So that was really the genesis of how I got it to HVAC. And then so how did it go from there? So he had a business. It was called K&S Heating and Air, based in Garland, Texas. He was, $17-18 million of revenue, and maybe 10% profit margin. But it was majority new construction. And I realized that, or I knew that investors don't like cyclical businesses, right? So I was like, okay, how do I raise money for this? I have the seller, I have a deal here, but I don't know how to raise capital for it. So I tried. I could only get very onerous terms. I was pretty honest with the seller. Like, these are the terms. I can close the deal and do a recap, and we can partner together, but I'm not sure it's in the best interest of the company. How about, I said, and by now we're in 2019, how about, I help you out for a couple of days, a week through the summer season this year, and see if we can get that revenue mix to be a little bit more palatable for investors. And then we do a recap and start like a more formal partnership, within the next 12 months. So I essentially became a consultant to this, a business that I really liked, gave me a very nice offer. I essentially became like a minority equity partner at this time, of the business. And, within a few months, we acquired another company that was fully focused on, in our business, we have two businesses. Essentially, we do new construction where the builder is our customer, and then we do service where a homeowner is our customer. So we acquired a business that did only service, and that really helped change the revenue mix. But more importantly, it became a fantastic case study, because we were able to, through our purchasing power on the new construction side, where we did a lot more scale, we were able to really enhance their EBITDA margins. And then on their side, they were, their bread and butter was doing retail or doing service to homeowners. They were really, all their technicians were trained on getting reviews and maximizing each ticket. So when they came over to, the platform company, they were able to double that service department within 6 months just by being much better at closing rates and average tickets. So it was a great marriage. And so that fall, I went back out to investors. I still had to deal with the CEO. We had upped it a little bit, of course, because we had grown by now. And I said, look, what we've accomplished. We have a good platform and we have a great add-on. We want to do more of that. Do you want to be our investor? And yeah,
great. Let me stop you there, Niklas, because I got a bunch of follow-up questions. So just going back to your initial goal with this person. So I understand that it evolved in the way that you just told us, but you initially approached him with the idea that you would buy his business outright, or that he would always stay involved. What was the initial pitch? Because I know it changed.
He was looking for a change to the status quo. I think he was feeling pretty lonely in his business. It had become a lifestyle business, and he was ready to kind of do something else and or get someone else into the team that could help take it to the next level. So I think initially he had engaged a broker to sell it and do something else. But as he got to know me and we really had good chemistry, I think he got more and more excited about the prospects of continuing to work on it and grow it. So that evolved a little bit. And this, I guess, maybe this is where you're going, but maybe this is the key, and where my mindset went from being a search funder where I'm going to run this business to being more of an independent sponsor where your mindset is, I'm going to grow this business, but not necessarily be the day-to-day CEO, because that would now be his role. So I would more, I would support him in that, right? And so that's where that transition happened.
And Niklas, so I understand what he wanted, and meeting you guys got along. It seemed like you could do something interesting together that would keep him, would scratch the itch that whatever he was kind of dissatisfied with in his business. But what about you? Because a self-funded searcher typically sees themselves as becoming the lone CEO and the seller leaving after a transition. So did you also have to adjust what you were looking for?
No, I don't think so. I thought it was a great fit in that I had a skill set with strategy and kind of that industry perspective from Linux. Also, I could see where this business can go, and he knew the day-to-day stuff. Even to this day, I'm quite mediocre on the technical items within HVAC. So I like the idea of relying on someone else to help me manage the operations. And so I don't know that I was looking for something else. I mean, really at the core of it, as a searcher, as an independent sponsor, what you're looking for is a great target to buy. And in my mind, how it's governed and managed has to be customized for each situation. And when you're a searcher, you're looking specifically for situations where the CEO is transitioning out, which actually reduces the number of opportunities you can look at. If you take a broader view, you can also look at other, more like recap situations, and partnership opportunities. And so by taking a broader view, we could create a win-win, which is, of course, a model that we have emulated many times since, with a lot of add-ons since then.
Great. And I want to, first, why did you like the business? Now, you just answered that, that you saw potential of what could be kind of corrected. But looking at it from the perspective of kind of the traditional parameters, the fact that it was heavy construction is yes, some searchers will say, well, that's the opportunity, is to increase the quality of revenue, to make it more maintenance. But most people will just walk. They'll just say, no, I just rather not do that deal, period. So how did you reconcile that in your own mind?
Absolutely. Yeah. By now I've been pretty well versed in selling why construction isn't so bad to investors and whoever. But my view was that construction in Dallas is going to be a decent industry to be in. There are some macro trends that you really can believe in. One of them is population growth. At the time, there were 6 million people in Dallas-Fort Worth. By 2045, there are apparently going to be 9 million people in Dallas-Fort Worth. And that may not be a straight line, but I knew that migration trends like that tend to come through. And if that's the case for Dallas, construction will overall be a great spot to be in. I can't tell you what, 2024 is going to look like, but I can tell you what the 2020s are going to look like overall as a decade. So if you take a long-term perspective and you have a fine balance sheet, there's opportunity there, because there's going to be activity. So that was kind of my macro view. And then on the micro level with this particular business, I saw an opportunity because they already had built out essentially a back office. I mean, it was a pretty sizable business, 17, 18 million of revenue. So they had a lot of the AOR and AP team right in place to scale it, which is not what you see on the service side too much of. They're much smaller typically. And then they, of course, are doing 2,500 homes per year where they can put their sticker on it. And they've been doing that for decades. So can you harvest those customers who are homeowners moving in, and your system is the one they're enjoying, and down the road they become homeowner clients? That's a lead generation source. So your cost per lead can be lower. Another thing is construction. It's cyclical, but it's not seasonal. HVAC is very seasonal. The summer season, it's great for us. The winter season is really slow for us. Homeowners don't need AC in the winter. So it's a very seasonal business. But by having construction, which is kind of even throughout the year, it helps with cash flow in the winter. And then the fourth argument that I like to bring up is it's also a fantastic training ground for our technicians. So especially some of those that are newer, they can go and do warranty calls or work with builders who are kind of long-term relationships. And it's a safe space where they can really hone their technical skills. before they go to homeowners, where it's not only technical skills needed, but you also really need to have that customer service and interpersonal skill set to add on to it. So I actually saw a lot of benefits with having construction and service together. I still do. I still believe this thesis is correct. But you have to be in the right geographies. I wouldn't do it in certain other geographies in the US. But being in Texas, I'm sure if you're in Florida, there are some really good markets to do it in, but you got to be selective on that.
Mm-hmm. Thanks, Niklas. That's great. Now, you mentioned recap. So this is going to be a very basic question to anyone coming from a finance background or private equity, but there are going to be other people in the audience who don't really, they kind of vaguely understand what that means. When you say you met this gentleman, you guys hit it off, you worked with him for a while, kind of on a consulting basis. You saw that there was an opportunity to come in as a formal partner. And so you did a recap. What exactly is a recap?
Sure. A recapitalization is really another word for selling, to be honest, but it's more technical in that you're talking about recapitalizing your balance sheet. Your balance sheet has a certain, structure today with debt and equity. And so by recapping, you are recapitalizing what that balance sheet looks like. So that's the technical approach to it. And it's just a word that is used a lot. There are two types of recap. It's a majority recap and a minority recap. And if you're above 50%, it's a majority recap. And if you're below, it's a minority recap. And this is a big distinction line. Some funds will only do majority recap because they want control in everything they do. That was also the case for me. And then there are some investors who only do minority recaps. So they're like investing for its growth equity. They're backing a management team. So you'll see a lot of that. And kind of when they pass the VC stage and they're looking for growth equity, that's technically a minority recap. They're taking on more equity to grow the business. And then I would say there are, in the growth equity model, that money is injected into the company to be used by the company for growth. In the private equity world, that money is injected in to be taken out as dividends for whoever was the selling shareholder. So yeah, that's a recap.
Great. And so in your case, what the recapitalization was meant to do was it was give you equity. So you bought into the business. So you, on the other side of the recap, you are now a part owner of this business. Your seller, now partner, has sold you some equity. So presumably he has a partial liquidity event. He puts some cash in his pocket. And through all of this, there's also investors whose cash and equity is what's being infused into to allow him to take money out of the business, to infuse the business with some growth capital, and then they also, I guess the investors, of course, also take some of the equity. So on the other side of this, it's, every business is different. So this gets very particular and complex quickly, but you've got equity, he's got equity. If reduced, the investors have equity, and there's more cash in the balance sheet to go out there and grow. Is that kind of the gist?
Yes, great summary. And I would just emphasize every deal is different. So in some cases, all the cash is taken out because the seller, that's the proceeds. In other cases, all the cash is left in the business to grow the company. And in those cases, the seller has particularly, or he has sold a portion of the company, right, in order to infuse cash that will help him to grow, which is what you see at VC, right? They sell a portion in order to fund continued operations so they can continue to grow. In the private equity world, I would say it's less about that and more about taking out previous owners.
So before we move on to your subsequent acquisitions, of which there are a handful, this first acquisition where this business brought all of these best practices around running a home services business, right? So asking for reviews and kind of all of the things that you're supposed to do to I guess position the home services business well on the internet among consumers, increase leads. This business had those best practices, and that was one of the big values of this acquisition, this first acquisition. But I'm struck that that you were able to import those norms into the platform, your original business, so quickly and effectively, because all we hear about here from my guests is how difficult doing any sort of change, any sort of cultural change is in a business. So you were, but in your case, you were able to take these practices and import them into your platform business relatively quickly, and have that be the new normal across the entire combined entity.
Yes, I would say so. And there are a lot of HVAC roll-ups up there, so I'm not going to say that we're the best or the worst or where we rank in that order, and everyone probably does it in different ways. But the overall, one of the reasons why HVAC is hot and why the multiples have been high and continue to be high is because this integration playbook has been, I think, largely perfected. And I think there are a number of reasons for that. A major one would be software. If you go back 15, 20 years, most companies would do pen and paper. When you call, they would put it on a whiteboard, and that would be their scheduling, right? In fact, I came across one of those targets there last year that was still doing it that way. But most companies today use software for this. And in fact, most companies use a fairly small 2 or 3 different software programs. And you can easily then transition them on. You then have all your customers in one database. So the integration of kind of the system and processes is easy. And also because of software, processes have been fairly standardized, or maybe company did things very differently before. Today, everyone uses the same software, so the steps they follow are more or less the same. So I think because of that, the risk has come down. And then on the back end, with size and scale, people are able to get more. When you roll up, you're able to get more out of the marketing, more out of the insurance, and more out of the procurement. So this is how you can enhance the margins, which we often talk about, not only adjusted EBITDA, but we talk about synergized adjusted EBITDA. So while our multiples are crazy high when we do add-ons for EBITDA, they're pretty ridiculous still when you talk about adjusted EBITDA. But if you look at synergized adjusted EBITDA, which I know is a lot to compound there, but it starts to look more rational when you do add-on acquisitions. And especially when you know that the risk of losing that revenue stream is relatively well managed.
Great. So returning to the story, so you're now a partner in the first platform business. You've done an acquisition, and I think you had stopped by saying you could demonstrate to the market and to the potential investors that there was a successful integration that you'd done, what you'd learned, and then you could, with some capital, kind of do it again and again and again. Is that where things were going to? Please pick back up the story.
Yeah. So, why is HVAC very popular for private equity players today? It's an extremely fragmented market. There are thousands, tens of thousands of HVAC contractors nationwide. Most of them are very small. Some of them are very big, but most of them or many of them are kind of decent size and good add-on targets that give you a new footprint and all that stuff, right? So it's a large fragmented market with a lot of targets. And, what do deal guys like to do? They like to do deals. So here you have a vertical with a lot of deal opportunities. Another reason I think private equity has gone after it is because it's relatively, well, compared to software, right? It's relatively unsophisticated. It's a lot of people who founded their business because they've been a technician and this is the way they've done it. But they've never taken kind of the private equity corporate skill set and strategy and applied that in a systematic way that you're now seeing at a high level things are being done. I've been in the industry for a few years now. This is changing pretty rapidly. I'm amazed by what I see some companies do today on the big scale. But, when you meet smaller targets, they don't have the resource or capacity or experience to apply that sophistication. So going back to why multiples are high, it's because you can add that sophistication and get a lot more value out of the targets when you acquire them and you already have that playbook running.
Great. And so returning to your story, you've now done 2 acquisitions. What do you and your partner then kind of decide the future should look like? And how do you then proceed to start doing more and more and more?
Okay, yeah, sure. Let me tell you more about the story, how it evolved. So we closed in the summer of 2020. It's almost been 3 years now. It took a little longer to close because of COVID. I think the investors said, let's wait and see what happens here. And what happened was that everyone was at home and wanted home services. So turned out to be okay. So we closed in the summer. The first thing we discussed was, do we divest our new construction? Do we grow it, or do we keep it stable? Just because we knew strategically this may harm our own valuation prospects down the road. And we made the decision to kind of keep it steady state, focus on maximizing profitability in that department, but continue to get the benefits that we are getting today. And then since then, all our focus has been on growing the service side. And by service, I mean when you pick up the phone and you need service, right, as a homeowner. So that will be your maintenance that you should do twice a year, or the service that you need whenever something goes wrong, or the replacement you're going to need every 10 to 12 years. And that's frankly where the margins are the highest, and the growth potential is the most kind of predictable and also most exciting. So our focus has been on growing that, like it is for every other HVAC roll-up. We've also added plumbing along the way because we have a huge intrinsic database. We have a call center, we have a software. So adding home services to the same platform makes sense. Typically, we'll see the trifecta of HVAC, plumbing, and electrical will be the third one. And then once you do that, people veer in different directions if they decide to add anything. But so we've added plumbing, and we focused a lot on organic growth. We have built out the marketing team here. And then we have done 6 add-on acquisitions to date since we closed 3 years ago. So there has been a nice combination of organic growth and inorganic growth. And of course, with the inorganic targets, I'll tell you, some of them were not, frankly, that profitable because, it's someone who's managing a business and paying themselves whatever net income they have. They're smaller targets, but we can come in and we have purchasing power that is a lot better than them, which dramatically either improves their margin or improves their competitiveness and pricing. And then we can insource a lot of the administrative tasks that this one person typically does on his own: accounting, HR, sales, call center, insurance, marketing. So by doing that, we're then able to get that entrepreneur, if he continues to stay with us, the founder, he can now be fully focused on his field team and customer experience. And so then you kind of get this margin improvement on the back end, revenue improvement by having marketing or in-house marketing take care of it, and then experience improvement, I guess I will call it, for both our team and our customers by having the now general manager or founder be fully focused on those aspects of the business. So yeah, that's the model. Again, we're not the only one pursuing it, but it is working, and it's been really exciting to see the growth and the story we've had so far. It's been a lot of fun.
And so, Niklas, to be absolutely clear, when you, for these bolt-ons, the seller, founder, owner, manager person typically stays on?
It's been a mix. Some have stayed on for a period and then transition now. Some are still with us. Some are fantastic matches. Others have, the culture alignment hasn't been 100%. So every situation is different. But we have systems in place to take them out if that's what they want. But if the upfront conversation is that, hey, a lot of them come to me and say, I'm just tired. I've been doing this for 20 years on my own. I'm just 50 today. But I'm tired of dealing with techs that are leaving because it's a labor shortage out there right now, or the supply chain issues that happened in 2021. It's just a lot to deal with, or I feel very lonely. That there's a theme of topics that continue to come up, right? And so I can then say we have the administrative back office to help you take care of that, so that you can then focus on what you enjoy the most, which is managing the team and taking care of the customer. Would you like to be part of that journey? So it becomes part of the pitch if that's the direction they want to do.
Mm-hmm, mm-hmm. And when you refer to all of this back office, the payroll, the accounting, the marketing, all of this insourcing that they can do, put in your hands, and then you'll do for them and do better than they were doing, likely. So do you have? So there's a mothership. I mean, there's a centralized entity that does all of that. And as a follow-up question, are you subsuming all of these bolt-ons under a single brand?
Yes, we do have a headquarters where most of that the operations happen, and then satellite offices around North Texas in our case, for those satellite offices that we have acquired. Remind me of the second part of your question there.
So if you have this, if you're sort of a centralized services model, what about the brand? Is there a single brand that everything becomes subsumed under?
Yeah, this is kind of ongoing discussion. It's also part of the premise, in some of the cases with the business owner, I will be very deliberate in saying we're going to preserve your brand and build on what you've built already. In other cases, I'm probably softer on that language because I am thinking that down the line we will incorporate a brand. So it changes a little bit from case to case for us specifically. Generally, I would say the industry is moving more and more towards having mega brands. But it's interesting because there was a roll-up kind of period that happened 20 years ago, and a big roll-up, kind of very infamous at this stage, did that, and it backfired. So they would take all these family-run local businesses and just day one change the brands. And it actually didn't work out particularly well for this private equity company. So for many years in our industry, the common knowledge has been don't do that because you don't want to lose the connection with the customer. But I think it's reversing back because there are operational challenges with having a lot of different brands, especially if it's the same geographic market, and you don't get the benefit of having one big brand that you kind of push all the time. So probably see more of that going forward than we have. And that includes ourselves with future add-on acquisitions. We'll probably do more of, bolt-on would be, or tuck-in more than add-on.
I didn't realize you were making a distinction there. That's good to know. Okay. And going back to your first acquisition where you found this seller owner and you guys effectively partnered in growing his business, are the two of you working in tandem to do this roll-up now, or have you kind of stepped above and are the one at the top doing most of this kind of higher level acquisition and integration activity?
Yeah, we've had a fantastic partnership and we still have a lot of fun. But he was in charge of day-to-day operations, and that's been the case throughout. In the initial period, first year in particular, I was very hands-on. We didn't yet have really a marketing department, so I would do a lot of that working with the agencies directly. We also didn't have a CFO yet, so I kind of took the reins on that a little bit for a while. But by now we have built out the team. And so my focus over the last couple of years has shifted towards being more M&A and strategy and more, stereotypical independent sponsor. So today I still run our M&A, but that's kind of the main day-to-day activity that I do with the company. The operations per se are taken care of by the team. And so when we do an add-on acquisition, I'm the front figure until we close, but we've actually transitioned to a point where I'm not there the day we announce it to their employees because we don't want to send too many people there and scare them off, and that they're not going to actually work with me on a day-to-day basis. I always make sure to go and say hello and get to know later, of course, but on that day one, we make sure to send our head of service and the CEO who they will be seeing and dealing with. And then, I'm more in the background, I guess, more as the private equity sponsor, which is what I am in this deal.
Niklas, I think I missed a little bit where you evolved from your relationship with the first seller that you worked with. You were kind of a self-funded searcher, but then you meet him and you see this opportunity to work with him, effectively partner with him and kind of really grow and transform his business. So then you've already shifted a little bit away from what we think of as a searcher, acquisition entrepreneur. But there's been continued to be this shift all the way to now an independent sponsor. Can you fill in the gap there? Has it just been this kind of very gradual process, or was there a moment where it crystallized in your mind like, okay, I'm going to step up out of hands-on operations and I'm going to be kind of independent sponsor, a sponsor of a real kind of private equity play here?
Sure. It's been more gradual. And I would say even when I was in the ed tech company, I actually looked at deals that were adjacent and synergistic with that deal. And so that's not very common for a search fund to do. But one of my board members said that a good way to overcome a not so good investment is to do a good investment, even within the same kind of deal. So if we could have bought a company like an add-on acquisition, that could have given us kind of a lifeline out of it, right? So that was, so I would actively have conversations even back when I was still the CEO of that business. And of course, when I was running that business, it became a question, well, how are we going to manage this business, which is in a different state? So I guess I familiarized myself with the concept of, having conversations, approaching sellers with not the intent that I necessarily would be the CEO, but I would be the new owner, but not necessarily the new CEO. And frankly, I think the conversation is almost easier when you say, well, let me flip it around. If you're hell-bent on being a CEO and you're 29 years old and you're straight out of business school, you don't have experience in that industry or specific skill sets that you can point to. When I can go and meet a seller and I say, look, we're going to hire, and in fact, here's a Rolodex I may have already prepared before the meeting of people that will sit on the board for this deal, and we're going to hire someone who's been in the industry for 10, 20, 30 years, who's going to help us run it. That really speaks to them because they're getting a whole team, an orchestra of people who are very familiar with this industry and business. And so it gives you more credibility, not less, to not have the hubris of saying, I am the one who's going to be the best to run this business. Now, it's nice to be able to say, I have run businesses before and I can be a backstop and support the CEO. And if, he's hit by the bus, I can step in and take care of the business and govern it. That's always good to say, but having a broader approach to that, I think, is well received by CEOs in general. Back to your question about kind of the gradual approach, I think also the independent sponsor world started to blossom in these last years of the last decade. And McGuire Woods is a law firm. They do a fantastic job. I think, in fact, they coined the term independent sponsor. They claimed previous to that it was called a fundless sponsor, but nobody wanted to be fundless, so it never took off. But everyone wants to be independent, so then it really took off. And they have an annual conference in Dallas in October. It's an excellent conference. They do an amazing job, great for networking. It's exclusively to investors and independent sponsors. And when I went to that the first time in 2018, I think there was 120 people, and you kind of got to know everyone over 2 days. And this past October, I think there was 1,500 people there. So the space itself is blown up, which means intermediaries are more familiar with it. So they will start to prep their target companies with, this is the kind of buyer you're dealing with here. Investors are more comfortable looking at deals that there is going to be an intermediary that has like a deal by deal economic structure. So that has also helped educated me, and kind of I've grown up in the industry as it's grown up and matured itself, so to speak. Mm-hmm. But people have always bought companies, I would say. I have one investor, and he says, this is kind of what I did 25 years ago. I found a company and bought it. People have always done it, just like people have always flipped houses. So whether it has a new terminology around it, it's still the same thing. All you're looking for is a great asset to buy. You have a seller and you buy it, and then you just need to solve for how to manage and grow it. And that's a constant effort, by the way.
Well, that was a very concise answer to my next question, which was let's define independent sponsor explicitly. It's a lot of syllables, and it's kind of has a fancy label, but it's really doesn't need to be. Let me take a stab at the definition. Somebody who goes out and finds an acquisition, business to buy, probably has investors that they're talking to, but they don't actually have committed capital yet. They find a target, and then they bring that acquisition opportunity to their investors. And then this is all negotiated deal by deal. So it's not, I'm sure there's some kind of market standards here, but it's not super well defined. That's all negotiated. And the independent sponsor puts the deal together. They earn money at close. They get some of the equity of the business. And then, of course, the capital that they raised, those folks are the LPs, the limited partners who are now also part owners in this business. And then in terms of governance, in terms of operations, that's a little murkier. Maybe the independent sponsor actually comes in as the operator. Usually not, right? Usually either the existing seller continues operating, or like you said, the independent sponsor is bringing a Rolodex and puts into place a new manager or management. I think I covered everything as I understand it. Did that all sound right?
It did sound right, and I'm looking for gaps to fill in, but I think it's a good summary. It's private equity, but on a deal by deal basis, and also so you call yourself a general partner, just like a private equity fund would, and your economics are modeled based on private equity. So you don't actually get equity, which is something you get as a search, at least a self-funded searcher. You get equity literally in the business, which is what I had with my first deal. In these situations, you can invest and be an LP alongside your other LPs, but your reward is going to be carried interest is like private equity. And so it's a nuanced difference and has some different tax implications, but effectively the same thing, right? You get a piece of the upside. You know, we can contrast it to search funds. We can dig into that if you want, but the general thing for an independent sponsor, how are you compensated, right? It's, there are three main components, and I've heard about other components you can have if you're very good at it and can add onto it. But you get a closing fee, which is going to be typically 1% to 2% of the enterprise value. In most cases, that's rolled into the deal as capital. And then you get a management fee, which in search terms would be very similar to, you know, taking a salary, but instead of it being a W-2 salary, you're going to get a 1099 payout. So nuance difference there because you're not taxed on it up front, right? And that will typically have like a floor and ceiling and then be a percentage of EBITDA, call it 5 or 6% of EBITDA with a floor and ceiling. And then lastly, you get carried interest where 20% is the standard private equity. And there tends to be kind of a ladder where if you do really well, you can get it up to 30% or more. So those are the three main components and the most standard approach based on the market terms that I've heard.
A couple follow-ups there. So the second bucket of compensation, the management fee, is that based on you doing, based on what? Based on being a board member or just being there as an advisor? Or what if you actually, I mean, might you actually have a formal role within the business? Like, what is that compensating you for precisely?
No, that's a great question. It's actually not very well defined. It's for governing the company and making sure that, you know, you're staying on top of management, you're providing reporting, you're putting together board. I mean, I guess you could call it like a chairman fee or board fee, but the management fee is the money that you get for overseeing this investment. And it's loosely defined what that entails. Independent sponsors will range from very hands-on, which I've been with this deal, to very hands-off and have many, many, many deals. And so that's a case by case, but management fee is the recurring revenue that you get for overseeing a company that is in your portfolio. And so an independent sponsor, this is typically where they will fund all their operating expenses and also fund future deals, but as well as live off of that.
Mm-hmm. And on the third piece of compensation, the carry, which is where, you know, the real interesting numbers would come from. That also presupposes, to your point, this is private equity, so that there is going to be some sale of the business that you've acquired. So that's actually an important difference with search, because at least in self-funded search, many self-funded searchers might want to hold onto the business indefinitely. In the independent sponsor model, you will be expected to sell the businesses at some point to realize your carry, correct?
That's unless you communicated otherwise up front, that would be the expectation. There are some independent sponsors out there who very deliberately take a different model from that, and they raise capital from sources who are happy to support that. But the default expectation would be that, you know, it's a 5 to 7 year hold. But I know people who buy deals and their goal is to get to cash flow where they get dividends, and the carry then kicks in after the investors have gotten their money back, plus typically an 8% return on that money. And after that happens, that's when there is a divide, call it 80-20 or 70-30 based on what your carry is. And so if you're as an independent sponsor get to that point where your investors are fully repaid and you have not only your management fee, but now you get 20, 30, 40, whatever percent of annual dividends. I mean, that's a sweet spot as an independent sponsor too, because then you have more to funnel into your next deals. Yes, you don't have a liquidity event, but you have a recurring revenue, and that is nice for the stability of your operations. I
still want to kind of dwell on the difference here between self-funded searchers, people listening to this primarily. One of the things in our world that is consider so challenging is being an operator, particularly with the transition, particularly as you're learning the business that you've bought. I mean, there's so much risk there. There's so much you don't know, no matter how thorough your diligence was. So a lot of people like to operate. They want to be an operator. That's certainly going to be a lot of the people listening to this. It's not something they're trying to escape. Others are. They want to buy a business. They love the idea of buying a business, and they are fully willing to operate it. But the end goal is not to be the operator. The end goal is to learn the business, operate it, and then put in an operator so they can step up or out of the business and do whatever they want, buy another business or who knows what. And for those folks who really don't want to be operators, it's kind of like the necessary step to their grander plan. I'm looking at you, or the kind of the independent sponsor model, and it feels like it is the way to do search without ever having to be an operator. I know you did get your hands dirty for a couple of years, but that was particular to your case, and I'm getting the impression that in general, that doesn't have to happen, and indeed, it may not happen. Like, you may be the exception, not the rule. So is the independent sponsor model the answer to being able to buy a business without actually and being able to skip the operations?
Yes. And I frequently talk to friends. In fact, just at my reunion here the other day, I have a friend who bought a business a year ago. It's going well. He's hired a president. He's still a CEO, but he sees a future. I don't know, 2 years or 10 years. I don't know the time frame he has in mind, but where that president will essentially take over all his responsibilities as a CEO as well. And then he has, in his case, a business that he owns. He did more in the self-funded search direction, actually, right? But so that's what I'm saying. Like, even in the self-funded world, a goal can easily be that they want to step out eventually, and they're sitting on a good asset. And at the end of the day, that's what everyone is looking for, a good asset. And some people, when they're sitting on one, they like to hold on to that.
Yeah. Well, I guess I'm just trying to understand or make it clear for the audience, like, should they consider, instead of being a self-funded searcher, if they don't really like the idea of being an operator, yes, they're willing to do it, but they'd rather not, should they consider being an independent sponsor, period? Yeah. So they're just kind of the deal person and really just the one kind of moving the pieces around. Because that's really what a lot of people will want.
Yeah, I think so. I think a lot of people will want that. I think also there are people out there who want another job. They're mid-career and they're becoming a searcher because they don't particularly like the career they're in or the job they have. So they're looking for a new job, and they essentially buy that new job for themselves. In those cases, they generally enjoy the operations, and maybe their ambition was never to do a lot of deals or become like a serial deal maker. They're happy to run a business for decades, right? So I think this really depends on the person and on the deal, but that's really the beauty of independent sponsor. Every deal is customized, which is where I think self or search funds are very prescribed in how they're approached and done. And so the pitch to intermediaries and to owners is going to be fairly standardized, but and in many cases that will be the right answer, but not in every case.
Yeah. And just what you just said about like a serial deal maker, and just think, so kind of making it clear for people what type of personality, what the distinction there is between an independent sponsor and a searcher. I've kind of been hammering that a searcher kind of more likely should like operations. Is it fair to say that somebody who likes the art of the deal, even searching, negotiation, et cetera, finance, that you like, you're going to need to be that type of person to be an effective independent sponsor? Is that a fair generalization?
I think a skill set that you often see independent sponsors have is business development. They're good at pitching and sales, because you have to sell yourself to intermediaries. You have to sell yourself or your concept to business owners, and then to investors, and then to a new team that you've onboarded. So business development is a big skill set in addition to those that you mentioned there. But then you have personality types who are, I'm just going to call them more like engineer mindset, or they like to solve kind of practical problems, or solve or sell to customers, or solve business problems, so to speak, for a customer, and get gratification for that. And I think we all get gratification from both, but they really bear towards that, and thrive as a CEO and love being in that position where they are the one running things. An independent sponsor is not the number one guy ever, if that makes sense.
You're behind the scenes.
You are, yes. So you're not the front face of anything. Yes, the CEO is working with you or reporting to you, but he is still the person in charge, and you rely even more on him than the other way around. If you want to look more broadly at the difference between search fund and independent sponsors, and I'm going to say traditional search funds here, maybe in particular. As an independent sponsor, you control your own deal flow. Nobody has paid you up front to own that deal flow. So that's an important thing. Number two, you have autonomy of your life, meaning you haven't signed up for a full-time search job, but also your fiduciary duty is not to be a day-to-day operator after you close. You're responsible for everything that happens and the results. But I'm European. When I went to college, nobody took count of where I was the whole year. There's an exam at the end of the year, and I'm accountable for my grade in that final exam. There is no follow-up or anything throughout. You can go through the auditorium and sit in big seminars throughout, but that's the model there. So you're responsible, but on a day-to-day basis, you have a lot of autonomy. When my wife went to college here in the US, it's homework assignments every week and kind of tests on a monthly basis. And there's a lot of follow-up throughout, which is what we have in high school, frankly. So there you don't have a lot of autonomy, but you're still responsible in the same way. So I enjoy the more autonomous route. I like the responsibility, but I also like having the flexibility around that. And then I would also say,
great analogy.
As a searcher, you've signed up for, or especially traditional, right? But even as a self-funded searcher, your pitch to the investors is, I'm going to be the CEO. I'm going to run this company. So you've signed up for that. And that's what you're doing until you exit, unless the board, and I've never heard this happen, but finds that you are an inferior solution to whatever they can find instead, right? So you've signed up for that, and hence your career is on the line too, and you're occupied with that until you're out of it. And that can be a multi-year situation. So your flexibility of your career is also diminished. Versus if you're an independent sponsor, you're responsible for governing that company. And that can also be a multi-year responsibility, but it may not take up your day-to-day in the same way, which gives you capacity to do other things. And also, you can actually sell that responsibility to someone, right? You have a GP position in something. It's a role and responsibility that can be traded. I don't hear this happening, but theoretically you could, versus the self-funded searcher. You're a little bit more locked in there.
Right. Mm-hmm.
And, just to double down on that, the expectations are different too, right? If you're managing the operations, that is the expectation from the board and from the investors, versus if you're overseeing the deal, you're going to try to find investors who are like, okay, this looks like a good deal. We also kind of want to help you oversee it. We have some expertise in this industry, and they kind of take a little bit more of an ownership mentality versus, hey, you're our W-2 employee, go implement this. It's more like, okay, these are our ideas, and they'll funnel them through me, so to speak. So the expectations are different there. The capacity that I said to have autonomy, most independent sponsors will funnel that into doing more deals. In my case, about 18 months ago, I was really close to closing a $6 million with the electrical contractor. I'm still bitter it didn't close, but a strategic came in just in, we were 2 weeks from closing. So it wasn't what it was, but I had capacity to find the deal, negotiate the deal, and diligence the deal. I had raised the capital for the deal, and it was fairly synergistic with my existing deal in HVAC because it's also a contractor. They were servicing different type of customers, but it was an easy sell both to the owner and to investors that, look, I have a portfolio company that is, it's labor intensive, it's blue collar, supply chain issues, right? So I had the story down, and I had capacity to take on another deal. That particular one didn't close, but maybe one will in the future. That's the beauty. And, most independent sponsors, that's what they do. They go and do multiple deals.
Can I actually jump in with a question? Make sure you remember where you are, Niklas, because I want to return to where you are. But before we get off the multiple deals, so you Are the multiple deals presumed in the case of an independent sponsor to be some sort of roll up where they're all synergistic, like what you're doing, or could you have an eclectic portfolio as an independent sponsor?
There are some big guys out there by now, and you meet them at this conference and they'll have 50 deals. These are the biggest guys. And imagine that you have 50 deals, where you get a management fee from each and every one of them. And this is the beauty really, because if you're a private equity fund and you raise a $500 million fund, great. You're going to get the 1.5% management fee every year, which is a lot of cash flow, and you get it right out of the gate. And you then build a team around it. But when you have raised a fund, your obligations are to manage that fund, and it's a 10, 12-year event, right? So it's a job, right? You've gotten yourself into a job when you raise the fund. If you, however, do 50 deals, each and every one of those is going to be kicking out management fees, which is how you've now hired a big team and you're able to do more and more deals. It's a snowballing effect. But, technically speaking, at least you're not locked into it because it's all deal by deal. So if you wanted to, you could step out, or you still have that autonomy. You're not expected to spend 50 hours a week managing a fund. Your obligation to those who have given you capital is still just to manage each deal on a deal by deal basis. And you have then done that for each deal. So I actually think down the line, if you can build this kind of scale, it's even better than private equity, right? Because you have that flexibility and you don't have to be anxious about raising your next fund, which is entirely contingent of the returns of your previous funds. It's always a deal by deal basis. If you find a good deal, you're going to get it closed. Even if you had 3 bad ones out of the last 10, it's always going to be contingent on that deal. So I wouldn't be surprised if, I'm not surprised to see that the independent sponsor space is growing as it is. And I wouldn't be surprised if you see larger and larger deals being done this way.
Mm-hmm. Thank you. Can you return to the point where you were?
Yeah, as we were talking about the differences between search funds and independent sponsors. As I mentioned before, an independent sponsor is going to have an inclination to try to find an experienced manager / CEO of the company. That's how they pitch it to investors. That's how they pitch it to the owner. And that becomes part of the whole governance arrangement that they put in place. I wouldn't say one thing that forces is an independent sponsor has to look for bigger deals typically, because there has to be cash flow in order to bring someone in, versus a self-funded searcher. They'll, pay themselves. I have a friend who's paying himself $120,000 a year. He's on a great pathway to build net worth, but it's not a huge drain on the company. So he can then afford to have a smaller company and buy a smaller company. And with an independent sponsor, if you're going to hire a management team, you need cash flow for that. And if you want to get the management fee 5 to 6% of EBITDA, you want it to be a little higher, right? So that's a nuance too, for sure. Anyway, so the inclination to find experienced managers, that will be a big difference. And then another point I would say, in my opinion, you come across more professional to sellers. If you're a guy who says, these are my investors, this is who I would put on the board, these are the ideas I would have around, what a new CEO should look like. And this is what I'm going to spend my time on to, help the business grow. We're going to do add-on acquisitions and really be focused strategically, not operationally, on taking it to the next level. I think that's a stronger pitch. If I was a business owner, I think that's a stronger pitch than if someone comes to me and it's gleaming across their LinkedIn, I'm looking for one single company to buy, and that's all I am doing and all I'm going to do. And you may be the lucky winner of my search. I think that's, passionate. And as a business owner, you obviously want to find a buyer who is passionate about taking over your business, that's going to take good care of it. But it's not necessarily confidence inducing in the same way as someone who has more of an infrastructure way to put it together.
Yeah, that's a great that's a great point, Niklas, because searchers, we're told that our pitch, the way we differentiate from a private equity buyer is, I'm going to bring my whole self to this business. I'm going to, take care of your legacy, and it's going to be me. And while that has a certain emotional resonance, yeah, it may not be what a seller wants to hear, or not necessarily what they want. It just may not be what they want. And just circling quickly back to put a pin on your point about flexibility, Niklas, you could do, despite the fact that your acquisitions, I believe, are all in North Texas, you could fulfill your role as independent sponsor from anywhere.
That is correct. And independent sponsors search for deals nationwide, and they have to travel regularly to oversee their deals, of course, when they do that. But you're not locked in to move to that one location where the company is based. It's, of course, an advantage to be there, but it's not necessary. And no private equity funds are ever in the same city as all their portfolio companies, right? So, yeah, similar mindset.
Yeah. Okay. In the search world, the other kind of trendy concept is a holdco. So buying a business, then stepping out and having multiple. So having a portfolio of businesses. And I think the appeal of that is because, well, it's bigger. It sounds like Warren Buffett. It's diversification, which really is the original reason for a holdco, a conglomerate, is to diversify, to have a portfolio that's diversified. I'm not sure that's why people think that, the people on Twitter talk about having a holdco. I'm not sure a pure diversification strategy is really what's driving them. I think it just seems cool, which is fine. It does seem cool, but it's starting to feel like, I guess the question is, now contrast the lucky few who do become holdco owners, who have 4 or 5 small businesses that they own outright, or some large piece of, versus an independent sponsor who's in 5 or 10 deals. Because that starts to feel almost very similar, even more similar than an independent sponsor and a self-funded searcher.
I agree. And it goes back to what we just discussed, where I have some self-funded search friends who have a goal of transitioning, finding someone to take their day-to-day job, right? And so it's really the same concept. I agree with you. Right. It's like, it's not black and white. It's really a spectrum of things. And a deal is one thing up front, but also over time it can evolve. And then I agree with you that's a very similar approach. So just different terminology. And that's quite consequential, because if you call it something else, you're going to miss out on the literature and conferences that exist about whatever you're missing out on, right?
Niklas, is there anything that you thought we would talk about that I have failed to ask you about?
No, I think it's a very rewarding pathway, and it's accelerating to continue to kind of encounter business situations. I think independent sponsor, the model, it keeps you kind of on the offense, in the sense that you're always going to be able to encounter new situations, as opposed to being stuck in one deal that, even if it's going well and growing 15% a year, that's what you're doing year in and year out. I think this is very dynamic on a year-to-year basis. And I like that about it. I foresee myself continuing to do more of the same. I've been, for the last 18 months, I've been pretty heads down with doing add-on acquisitions and making sure we optimize the returns on this one acquisition that I'm in now. But I do look forward to doing more of the same in the future, and meeting good partners on the way to accomplish that, both in home services and beyond.
Mm-hmm. Well, it's pretty intriguing, Niklas. It's going to be new to a lot of my audience. It's new to me, even though there's, as we've been kind of touching on this whole time, there's actually a lot of overlap. But there's this whole conference devoted to independent sponsorship that I wasn't aware of until recently. That's grown 10 times in the last few years. A lot of my audience will not have heard of that. That's the McGuire Woods conference in Dallas.
Yes.
Great. So this is going to be. I'm really glad that we did a real deep dive here, because as I said, I've glanced off of independent sponsor, the term, many times in the pod, but never addressed it head on, and it's really kind of eye-opening. And I'm sure people listening will feel the same. So thank you, sir, for so much time and so much transparency about what you're doing. Congratulations so far on what you built already. And let's check in a year and see where things stand.
Thank you so very much, Will.
Niklas, how can people reach you? What's your preferred way?
Please add me on LinkedIn. That's always exciting to be connected there. And then my email address is nicholas.james@gmail.com. I use
Got
one
it.
for business purposes as well, but people from this podcast can reach out to me personally.
Great. Well, expect some inbound. Thanks, Niklas.
Thank you as well.
I hope you enjoyed that interview. Make sure you subscribe to the Acquiring Minds channel below. We are now publishing twice a week, so tons of new interviews and stories to come, stories that will help you along your own path to acquiring a business.